Chalo. Very good evening, everyone. How are you all? Everyone. First, let me know that is the voice audible? Everyone. I hope everyone is preparing for the examination and they are doing good. One thing is that every day is very important. Got this point? And every day is counting. Okay, sir. So, voice is audible or not? Yes, sir. Voice is audible. Can we start day 2 live doubt session? Yes, sir. We can start. So, one by one, you can write down your doubt. Okay, I'll be just going through first doubt, then second doubt, then third doubt in the order, in this order. Okay, sir. At the last day, means day 1, due to some technical issue, I was not able to continue the live doubt session. Okay, so I'll be also taking that doubt which were pending. Okay, if the time permit, if the time permit, I will take that doubt. Or if you are available, if that student is available today also, so you can put that doubt once again in this live video also. Okay, yes sir. So can we start? Manikanta, first Manikanta, how are you? Okay, so his doubt is what? Dear sir, thank you very much. My doubt is with regard to service concession arrangement. Appendix D to Ind AS 15. Okay, sir, everyone, I hope you know about Appendix D to Ind AS 15, service concession arrangement. In intangible asset model, so of course there are two model, intangible asset and financial asset model for the accounting treatment. Okay, we are recognizing same revenue twice just to find out net profit when compared to the financial asset model. Correct, 100% correct. In intangible asset model, actually we are recognizing revenue twice. One, at the time of recognition of intangible asset. For construction services, we pass one journal entry intangible asset account debit to revenue from construction services. And as and when the amount is collected, from whom? From the user of infrastructure, then that point of time also we are recognizing revenue. At that point of time also we are recognizing revenue. So of course in this case we are recognizing revenue twice. This is what I will say, this is you can say this is one of the limitation of this model, but we don't have any other option in this case, because can is we need to recognize revenue from construction service also and revenue from operations also. Understood? However, the intangible asset will be amortized. The cost price of intangible asset will be amortized during what? During operation period. Automatically, can I say the revenue minus the amortization of what? Intangible asset. So automatically that will be set off. But you can't recognize revenue net of what? Amortization. That is not permitted in Appendix D to Ind AS 15. I hope you have understood. Let me see what is your doubt. So here is saying that we are recognizing same revenue twice just to find out net profit when compared to financial asset model where we have unconditional right to receive payment. So it is right way. So whether it is right way of accounting, of course I have said that there is no other option, so it will be a right way of accounting only. Can we directly set up amortization expense with the amount of receive in operation phase? No, this is not permitted. This is not permitted to find out net profit. Instead of recognizing gain, again collection revenue, again what here? Instead of recognizing again collection revenue, again amortization expense. I think you understood my doubt, sir, because I have understood your emotions, but that is not permitted. To amortization expense cannot be set off with the revenue during operation phase. Revenue will be separately recognized, amortization expense will be separately recognized. I hope your doubt is over. Manikanta, are you listening? Now coming to the next doubt. Vivek Satyal. How are you, Vivek? Sir, I always have doubt about OCI item. Can you make some discussion about it? OCI component. Okay, sir, of course, we'll have a discussion about that OCI component. Now, actually, what happened? See, now we know that SOPL have two parts. Everyone know that SOPL have how many parts? Two parts. Okay, sir. So, SOPL, one will be profit and loss, second will be OCI, and the total will be total comprehensive income. However, everyone knows that this statement should be statement of comprehensive income, but because of our Companies Act has not used the terminology statement of comprehensive income, therefore we call it statement of profit and loss. But actually, it should be statement of comprehensive income. Now, the student means Vivek is asking that he has a doubt about OCI. Normally, what happened? There were many gain and loss which we directly transferred to balance sheet under our previous gap. For example, revaluation gain. Revaluation gain we used to transfer directly to what? Revaluation surplus under accounting standard. But can I say any income and expense would be routed through statement of PL? However, it is unrealized. Unrealized. So now, as per presentation purpose, this is only for presentation purpose. The net effect will remain same. So what our index is saying that any unrealized income and unrealized expense will be now first transferred to OCI, and from OCI it will be accumulated in separate component of equity, means in other equity. For example, revaluation gain being unrealized profit will be first credited to OCI and accumulated as revaluation surplus under other equity. Understood? We can take many other examples. For example, under Ind AS 21, there is an exchange difference arising from translation of foreign operations. So that exchange difference can be exchange gain or loss. That is also unrealized. So that will be also routed through OCI and accumulated in FCTR in other equity. There are some other OCI component as per Ind AS 109. We have equity instrument, financial asset, equity instrument. So in that case, it can be classified as FBTOCI. So that will be also the any fair value measurement gain or loss will be transferred to OCI and accumulated in separate component of equity. So what our India says that any unrealized income or unrealized expense which is permitted by India, means it should be permitted by respective Indias, will be transferred to OCI and accumulated in separate component equity. Means you cannot transfer any income and expense to OCI if it is not permitted under Indias. Means if Indias has permitted, then only the unrealized gain or loss will be transferred to what? Unrealized gain or loss will be transferred to OCI. I hope you have understood. Now you will have doubt, sir. There are many unrealized gain or loss which is transferred to PL also. For example, if we take Ind AS 41, Ind AS 41 में biological asset are measured initially at fair value less cost of sale and subsequently also at fair value less cost of sale. So that measurement gain or loss, that when you are measuring at fair value initially and subsequently there is some gain or loss, that is also unrealized. So that unrealized gain or loss will be transferred to PL. So when I am saying unrealized income and unrealized expense will be transferred to OCI, it does not mean it cannot be, means unrealized income and expense cannot be transferred to PL. What I am saying that will transfer to OCI only when Ind AS permit. Ind AS permit. Logic is only presentation purpose, because all the income and expense should be presented in one statement for the better understanding of the user of financial statement. I hope you have understood now. Vivek, whether your doubt is over or not. Once your doubt is over, just say that yes sir, understood, so that I can continue with other doubts. Okay, now coming to Ram Akli. Ram Akil, sorry if I am pronouncing the name wrong, so I am sorry for that, because it is quite possible that sometime I am pronouncing the name wrong. Sir, under India 36, carrying amount of CGU is 21,20,000. So he is saying that carrying amount of CGU is 21,20,000. Okay sir, I am writing. Recoverable amount is how much? 20 lakh. 20 lakh. So impairment loss is how much? 20,000. Should be first allocated goodwill. Of course, it will first allocate goodwill or corporate asset which is not allocated in stage 1. It will first allocated goodwill. In stage 2 also, it will first allocate goodwill. Any balance impairment loss will be allocated to unallocated corporate asset which was to corporate asset which remain unallocated in first stage. So it will first allocated goodwill only. Understood? Have you understood this point? Ram, is your doubt over? Okay, sir. Ram. Chalo. Rajendra Nayak. Rajendra Nayak. Sir, if the fair value of inventory is increased compared to the book value on the date of acquisition and in the post acquisition period, the inventory was partly sold, then how it should be adjusted in SONA? Very good doubt. Now in SONA means statement of net asset. We write down date of acquisition, we write down post, we write down date of consolidation, correct? Now we are doing fair value adjustment of inventory. So fair value adjustment inventory. So he is saying that inventory was increased by 20,000. Suppose, let me here, has he taken some amount? He has not taken. Suppose the fair value has been increased by 20,000 on the date of acquisition, correct? Now I am just giving three situations. Just try to understand. If this inventory remain unsold during the post acquisition period, then no adjustment will be there, and this will remain in the balance sheet. This 20,000 will be also adjusted in consolidated balance sheet. Means in CBS your inventory should be increased by 20,000. Now second situation is what? If it is sold, then can I say if it is sold during post acquisition period, so whenever inventory is sold, then the carrying amount of inventory should be recognized as an expense, that is cost of sales. So during post acquisition period, your cost of sales will increase. It means post acquisition profit will decrease. Therefore, it will reduce your post acquisition profit. And ultimately the effect in the consolidated balance sheet will be nil. Means the inventory will not be adjusted in CBS. Third situation is what? Suppose out of 20,000, means out of the inventory which were acquired on the date of acquisition, 50% has been sold and 50% remain unsold. Simply you do 10,000 from post acquisition profit minus, and the 10,000 will remain in the balance sheet. Means decrease your post acquisition profit by 10,000 and increase the inventory in consolidated balance sheet by 10,000. I hope you have understood. Correct. This is when there is a increase. They may be reverse also. If suppose the inventory has been decreased by 20,000, so reverse effect. So if it is decreased by 20,000 and if it remain unsold, so this is the case, correct? If it is sold, then you need to increase the post acquisition profit by 20,000. If it is sold, this is the effect. I hope you have understood. Rajendra Nayak, have you understood? Got it, sir. Thank you very much, Rajendra. Yes, sir. Then without, then the boss Abhimani. Abhimani. Hi, sir. What is the difference between market rate of interest and effective rate of interest? Very good question. Market rate of interest and effective rate of interest. There is a lot of doubt in financial instrument chapter. So just try to understand. In financial instrument chapter, whenever you are doing any question, there are actually three rate of interest. One is known as contractual rate of interest, one is known as market rate of interest, one is known as effective rate of interest. First, just try to understand what is the importance of each rate of interest. This contractual rate of interest always you will use to calculate contractual cash flow. Contractual cash flow means whenever you are calculating contractual cash flow, you will use contractual rate of interest. Whenever you are calculating fair value of financial asset or financial liability, you will use market rate of interest. And whenever you are calculating amortized cost of financial asset or financial liability, you will always use Which rate of interest? Effective rate of interest. Means finance amortized cost will be always calculated by using effective rate of interest. Means your interest expense or interest income will be always calculated based on effective rate of interest. This is the actual concept. One second, can you the person and the student who have asked this doubt, just try to understand. Just try to understand. See, in financial instrument chapter, always there will be three rate of interest. Contractual rate of interest means the financial instrument has been this instrument has been entered in which rate of interest. So that become contractual rate of interest. Market rate of interest means whatever is prevailing in the market. Effective rate of interest that we calculate for calculating the amortized cost, or we can say for calculation of interest income and expense. Correct. Now just try to understand. This contractual rate of interest and market rate of interest will be always given in the question. Will be always given in the question. The contractual rate of interest and market rate of interest will be always given in the question. Effective rate of interest may be given, may not be given. May not be given. So if not given, we should know how to calculate it, because it is impossible that market rate of interest is not given, because in exam we can't go to the market and calculate and identify market rate of interest. So market rate of interest will be always given the question. Means if question is silent, always will assume that contractual rate of interest and market rate of interest are same. Are you getting what I am saying? Means if suppose market rate of interest is not given, it is quite possible. It means contract is made at market terms. It means contract is made at market terms. Understood? Let me explain. Suppose instrument is at market terms. Instrument is at market terms. Understood? It means in this case contractual rate of interest is equal to market rate of interest. Now whenever market rate of interest is not given, it means, just write one, it means instrument is at market terms. Means in that case contractual rate of interest and market rate of interest will be same. Means can I say in that case whatever transaction price you have paid or received, in case of financial asset we pay consideration, in case of financial liability we receive consideration. So we call it transaction price. Transaction price will be always equal to fair value. Means what is the meaning of fair value? Fair value means present value of contractual cash flow discounted at what? Discounted at market rate of interest. Correct. So if the instrument is at market terms, so of course whatever consideration you have paid, that is nothing but fair value. So in that case transaction price paid or received will be always equal to fair value, and there will be no difference. There will be no difference. Have you understood this point? Yes, sir. However, if it is not at market terms, means in this case, can I say market rate of interest will be given, and that will be different from contractual rate of interest. Means contractual rate of interest will not be equal to market rate of interest. This point have you understood? Correct. In this case, can I say we need to find out a fair value of that financial instrument, which will be equal to present value of contractual cash flow discounted at what? Discounted at, because whenever you are calculating fair value you will use market rate of interest. Discounted at market rate of interest. And can I say in this case the transaction price paid or received will not be equal to fair value. Means there will be some difference. We will compare transaction price whatever paid or received with the fair value, and this difference will be accounted as per the substance of the contract. Understood? Means it can be either charged to profit and loss account as an expense, or it can be recognized as an asset. I hope you have done a lot of questions. Sometimes we recognize it as prepaid EB expense, or we can recognize it as ROE asset. We have done one question of security deposit. So this will be accounted as per respective Ind AS, I will say, depending upon the nature of contract. So I will say this difference will be recognized as per indices, respective indices depending upon the substance of the contract. This point have you understood? This point you have understood? Now you can see in both the cases, actually you are calculating fair value only. So here also fair value is equal to what? Present value of contract or cash flow which can be inflow outflow depending upon it is financial asset or financial liability at market rate of interest. But here fair value will be equal to transaction price, therefore we do not calculate it, because in that case calculation is not required because transaction price paid or received is given. Now you need to ask, is there any transaction cost? So if there is any transaction cost, so I hope you know that for financial asset initial recognition is done at fair value plus transaction cost. For financial liability, if it is at amortized cost or FBTOC, I hope you have understanding. So for financial liability initial recognition is done at fair value minus transaction cost. So is there any transaction cost? So if the answer is no, there is no transaction cost. Understood? Hello? Is the voice audible? Is the voice audible? Okay. Is the voice is audible? Yes, sir. Okay, sir. 1 minute. Now, coming to everyone. So what am I saying? Is there any transaction cost? So if there is no transaction cost, it means, can you see you are recognizing the instrument at fair value only? In this case, the market rate of interest and ER will be same. Market rate of interest will be equal to ER, means we can say ER will be equal to market rate of interest. ER will be equal to market rate of interest because there is no transaction cost. But if yes, there is a transaction cost, then you are doing recognition at fair value plus minus transaction cost. I hope you have understood. Therefore, in this case, effective rate of interest ER will not be equal to market rate of interest. This point I have understood. In this unit to calculate ER if ER is not given in the question. However, normally in exam they will give ER, but can you see in this case ER and market rate of interest are different. I hope this point you have understood. Got this point? Bolo. Have you understood? If you have understood, please write down yes sir, we have understood. If it is others doubt also, and if you are listening this video, just write down yes sir, we have understood, so that I can proceed. Means suppose ER is not given, then ER will be equal to what? It will be the rate of interest at which present value of contractual cash flow should be equal to fair value plus minus transaction cost. Fair value plus minus. I am writing plus is for financial asset, minus is for financial liability. Got this point? So we need to calculate it. However, normally ER will be given in the question. So you can see in one question there can be three rate of interest. One is contractual rate of interest, one is market rate of interest, one is effective rate of interest. Contractual rate of interest is for to calculate contractual cash flows. Market rate of interest is always used to calculate fair value only, not for interest income or amortized cost. And effective rate of interest will be used to calculate what? amortized cost and corresponding interest, income and expense. Understood? Ha. If there is no transaction cost, then market rate of interest will be means ER will be equal to market rate of interest. So in that case also you are recognizing amortized cost at ER only, but in that case ER is equal to market rate of interest. Got this point? Yes, sir. Very good question. Normally students have a lot of doubt in this. So I will say thank you to Abhimani. Yes, sir. Now coming to next one question of Siva Ranjani. Hi sir, I have watched your marathon lecture. In consolidation, chain holding, two adjustment you have told. No consideration is paid for subsidiary. Why we are taking PC for sub subsidiary? Now I have said I in marathon batch, so I normally don't discuss this point. In my regular batch, I normally discuss this point. So I have said that use ICAI solution. Go as per ICAI solution. So do you have any doubt about ICAI solution? Siva Ranjani. So I will right now only discuss whatever the solution has been given by ICAI. I will not discuss the other solution which has been given by me, because that is not important from examination point of view. I always say that to give answer as per ICAI solution, and I have given the logic about my alternative solution. So Siva, what is your doubt? Doubt I have not understood. If you are asking my alternative solution, so that I will not discuss in this doubt group. Okay? Okay, sir? Yes, sir. Now coming to next point, Mamta. Sir, dismantling cost will be current liability or provision as per India's satisfaction. Arey, provision can be current liability or non-current liability. Of course, it is a provision. Now, provision can be current liability, it can be non-current liability. So, if the provision is expected to be paid after 12 months from the reporting date, it becomes non-current liability. Otherwise, it will be current liability. So, dismantling cost, the provision, we call it provision for dismantling cost. Normally, it is always non-current liability. Why? Because it is always payable after 1 year from reporting date. So, normally in every question, means I will say most of the question provision will be non-current liability. So just be careful, if it is payable within 1 year, then it becomes current liability. Mamta, your doubt over? Bolo Mamta. Yes sir, Mamta, doubt over. Coming to next doubt about, one second, listening sir, Manikanta, okay, sure, and also in reserve. I didn't get the logic. Manikanta. Sure, and what was your doubt, Siva? Chain holding, na. Chain holding first. Siva, explain me, what is your doubt? Okay, sir. Means your doubt was regarding what? Your doubt was regarding my alternative solution. Now that I am not going to discuss. You have understood ICAI solution, so go for it. You have understood ICAI solution, go for it. Siva, okay? Now, next point. Okay, sir. Are you able to understand now? Krishna. Sir, whether we need to create DTL on goodwill arising on business combination in case goodwill is tax deductible. Yes, if goodwill is tax deductible, now you should calculate deferred tax on that. And in one of the exam, actually they asked this question, and actually what happened, that question was taken from international book. In India, goodwill is not tax deductible. So normally from my point of view, that type of question should not be asked in exam. One time they have asked, that is by mistake they have asked. In the solution, actually they have not considered DTA or DTL on that goodwill. I hope you remember that question. So from my point of view, now they should not ask any question of this concept. So normally goodwill is not tax deductible, and therefore we do not recognize any deferred tax liability on that. But suppose in exam they have given goodwill is tax deductible, so you should calculate DTA or DTL on that. Understood? Have you understood, Krishna? But they will not ask this type of question. Got this point? Yes, sir. Hare. Revenue with customer. Hare Darshan. I think this question you have asked last day also. Now I have question number 86 of Ind AS 115. Come to question number 86. Question number 86. I've already opened. Question number 86. What is your doubt? Let me first. Sorry. See, relating to undiscounted reward point, part C, I could not understand the working, sir. Okay, I have understood your doubt. So I'll just give a reference of this question. Thoda sa I'll just give a knowledge. In this case, KK Limited run a departmental store with 10 points. They give 10 award points. Okay, sir. For every 500 purchase, rupees 500 purchase. Now it is given that they will give this discount can be redeemed within 3 years. How many years? 3 years. How many years? 3 years. Value of each point is also given 0.50. During the period 17-18, the entity awarded 1 crore point to the various customers and 18 lakh point redeem undiscounted. Out of 1 crore, 18 lakh point remain undiscounted in the first year. Means 18 lakh can be discounted in second year and third year. The management expected out of 18 lakh, 80% of the remaining will be discounted in future, either in second year or third year. So out of 18 lakh, 18% will be discounted. So what is the 80%? So 18 lakh into 80% is equal to 14 lakh 40,000. Okay. The company has approached you. Now the company has approached you the following accounting treatment. So in this case, what happened? First we need to understand point number B to understand point number C. So point number B, they have asked how much, what would be the revenue to be recognized in the first year? How much revenue will be recognized in the first year? So can you say, just try to understand, the total sales of the first year has been given 5,000 lakhs. 5,000 lakhs. Understood? Now the points will be how much? What will be the number of points? Number of award points. They have given 10 points for rupees 500. So we'll do into 10 divide by 500. So this will be the number of award points. So number of award point will be how much? 5,000 into 10 divided by 500 is equal to 100. So this will become 100 lakhs. This will become 100 lakhs. And what is the value of award point? Value of award point will be 100 lakhs multiplied by 0.50. So that will be 50 lakhs. This is the standalone selling price of award point. Now this means the transaction price is how much? 5,000 lakhs. So can you see there are two things. One is the sale of product and one is award point. These are two performance obligations. What is the standalone selling price? This is 5,000 lakhs and this is 100 and this is 50 lakhs. This is the standalone selling price. Understood? So this become what? 5,050 lakhs and the total consideration whatever we have received is how much? 5,000 lakhs. So this 5,000 lakh will be allocated in this ratio. Allocated in this ratio. So this you can allocate. This you can allocate. How much it is coming? So this will be 5,000 into 5,000 divided by 5050. This is coming how much? 49. This will be 4950.50, correct, minus 5,000. So this is coming how much? 49.50. So can you say out of 5,000 lakh we recognize this much revenue? The first journal entry will be what? Bank account debit to revenue, and how much revenue will be deferred, and deferred revenue will be how much? So this is how much you receive, 5,000. This is 4950.50 and this is 49.50. This is the first journal entry. Now in the first year, out of total point, what was the total point? Total point was how much? It was 100 lakh. Out of that, 18 lakh remain undiscounted, and out of 18 lakh, 80% is expected to be discounted. Means now can I say, we can say in this way, out of 100 lakh points, how much has been discounted? So 100 minus 18, so 82 has been discounted and 18 is remain undiscounted, out of which 18 into 80%, 14.4 will be expected to be discounted. So out of this deferred revenue, 49.50, how much revenue will recognize in first year? So that will be based on the point discounted. So 82 discounted, and how much is the total point which is expected to be discounted? That will be, can I say, 82 plus 14.4. So we need to find out what is the award point which is expected to be discounted in first year, second year and third year. So expected to be discounted in first year, second year, third year will be 82 plus 14.4. So this will come how much? So this will be 96.4. So 49.50 into 82 divided by 96.4. So that is coming how much? So 42.10 will be recognized as revenue. So one more journal entry will pass. The deferred revenue account debit to revenue, how much? 42.10. 42.10. So how much will be liability, means what will be the deferred revenue as on the end of the first year? That will be how much? How much was the total deferred revenue? 49.40 minus 42.10. This is how much? So 49.50 minus 42.10, it is coming how much? 7.4. So this becomes the outstanding liability, means deferred liability as on balance sheet date. This you have understood. Now let us come to point number C. What was your doubt? How much of deferred revenue should be recognized at the year end 17-18 because of estimation that 80%. This though I have already explained. Point number C though I have already explained. I was thinking that you have doubt in the next year. Point number C you have understood? Bolo. Your doubt was related to point number C, na? Manikanta. Your doubt was related to point number C or point number D? Point number C, have you understood? This was point number C only. Respond fast. Yes sir. Chalo, your doubt is over. Hare Darshan. Now coming to next point of Hare Darshan only. Financial instrument question 63. Logic of booking income at EIR and expense at contractual rate of interest of financial asset. Expense? Expense? How expense will come in financial asset? There is no expense in financial asset. Rather than computing on fair value of contractual cash flow discounted at EIR. Your question is wrong. Now I hope you understood that fair value is calculated by using market rate of interest, not by using EIR. This was the mistake you do. For fair value we want EIR. If question is silent, if nothing has been given, we'll assume contract is at market terms only. Understood this point? Hare Darshan. I hope now you will understand my emotions. Correct. Let me come to question number 63 of financial instrument chapter. 63. You can see this. So I think you are asking doubt about these debentures now. This point you are asking doubt now. So what they have given, check karenge. Purchase 6% debenture in Fox Limited on 1st April for rupees 1,50,000 as an investment. Blueberry Limited intend to hold a debenture until the redemption at a premium in 5-year time. The effective rate of interest of the bond is 8%. So they have given effective rate of interest. So there might be some transaction cost that is not given. Or they have given effective rate of interest. Understood now? Correct. So it means just try to understand. See, there is no need to calculate. Yahan pe fair value. They have given effective rate of interest. Effective rate of interest is always used to calculate what? Only amortized cost and interest income. So here, batao, initial recognition will be done at 1,50,000. Correct. Then interest will be calculated at 8%. So 1,50,000 into 8%, how much? You will add 12,000. Then contractual cash outflow will be at 6%. So 6%, 1,50,000 into 6%, how much? 9,000 minus kar do. So what is the balance? 1,53,000, and the answer is what? 6% debenture in Fox Limited is 1,53,000. Understood? So you can see whenever market rate of interest is not given, it means contract is at market terms. This you need to understand. यहीं पर गलती करते, देयर इज नो नीड टू कैलकुलेट फेयर वैल्यू, यहाँ पे फेयर वैल्यू कैलकुलेट करने की जरूरत नहीं है, देयर इज नो नीड टू कैलकुलेट इट. Manikanta, now you have understood. And also premium is given, sir. Premium is given, sir, until their redemption at premium. Now redemption can be at premium. Now if the redemption is done at premium, it does not mean that it is not at market terms. Market terms means what? The contractual rate of interest has been designed in such a way that it is equal to market rate of interest. Are you getting? So if the instrument are redeemable at premium, who has said that this cannot be at market terms? This can be at market terms now. So it can be issued at discount, it can be issued at premium, it can be redeemed at premium. So it does not mean it is not at market terms. Means the instrument has been designed at market terms. So it means contractual rate of interest and market rate of interest are same. Got this point? Got this point or not? Yes, sir. Understood. Hare, understood. Good question. I will say these are all doubtful questions. These are all doubtful questions which you will not be able to understand when you are taking classes. This will come only at a time of revision. Question 45, 7th edition. Can you explain logic alone, sir? So this is financial instrument chapter. I think you are asking about financial instrument chapter only. So come to what? Question number 45. Question number, what is question number 45? Acha, this is a question of impairment. Impairment. Let me explain you what they want to say. Bank originate 2000 bullet loan with a total gross carrying amount of 5 lakh. Means they have given how much loan? 2000 loan. Means there are 2000, I will say 2000 loans has been given with a total gross carrying amount of 5 lakh. Bank segment its portfolio into borrower group X and group Y on the basis of shared credit risk characteristics at initial recognition. Now what happens whenever they are large customer, because can you say for bank these are debtor, and for debtor we always calculate impairment loss by using lifetime ECL, and in that case normally what happens, we divide debtors based on what? Credit risk characteristics, means depending upon their credit portfolio. Understood? So that is given to, they have divided entire customer into two group X and Y. Group X comprise 1000 loan with a gross carrying amount per client 200, so it become 2 lakh. 1000 into 200. Group Y comprise 1000 loans with a gross carrying amount per client 300, and that total amount become 3 lakh. So 2 lakh plus 3 lakh become 5 lakh. There is no transaction cost, and the loan contract include no option of prepayment, and there is no call option, there is no prepayment, so there is no embedded derivative in it. They just want to say there is nothing in there. Premium or discount, there is nothing is there. Calculate loss rate. So you need to calculate only loss rate. Loss rate means at what rate the loss allowance will be calculated, means the allowance for bad and doubtful debt. So they have given as per the past experience, 4 client in group X will default, 2 client in group Y will default, and the present value of observed loss means the present value of the contractual cash flow which is not recoverable, that is 600. They have given present value. Thank you very much. I just come to the solution. Now you can see group X, group Y, how many client? 1000. What is the amount per client? 200, 300. This become 2 lakh and 3 lakh. Now who are lakh? 4 and 2. Their amount is what? 400 into 200, 800, and 2 into 300, 600. Present value is given. Means this is the present value of this. So we want present value of contractual cash flow which are not recoverable. That is given. Now loss rate will be what? 600. This is the loss which is going to happen. Divide by total amount. This is the loss rate. 450 divided total amount. This is the loss rate of group Y. Understood? I will say this is very simple question. Can be asked in exam. Any question of ICAI study material is important. So you can't ignore any question. Got this point? Bol. Haridasan. 45 also you have understood? Yes, sir. Come to Mohan Kumar. Mock test 1, May 2020 case scenario. Case scenario now, I'll come with, you have asked mock test 1. May 2000. You are asking about ICAI mock test now. So ICAI mock test I will discuss in some other live session. So I'm not taking mock with case study. Case scenario I'm going to come either live or recorded, that I have not decided. But I will explain entire case study separately. Chalega Mohan Kumar, Mamta. Sir, in ICAI material solution not consider as provision. Sir, in ICAI study material solution not consider as provision as per India 37 means which question? Like question batana. How can I understood? Not consider as provision? It will be provision now. It will be provision means what they have written? Discount decommissioning liability. This is provision for decommissioning liability. That will come under provision only. This is provision for decommissioning liability. Just write when sometime ICAI solution they don't write appropriate answer. Okay. But in exam it will write down appropriate answer. So appropriate answer is that is provision, and that provision will be either current liability or non-current liability. Chalega. Krishna Teja. Krishna Teja, sir, at what value reacquired right will be recognized in the books of acquirer book? So at fair value on the date of acquisition. The reacquired right will be recognized in the books of acquirer at fair value on the date of acquisition. At fair value. Understood, Krishna? The simple at fair value. Mohan Kumar. Once again he has asked mock test. Mock test I will not answer right now, please, because I need to open that case study. I don't want to discuss case study because the case study I will discuss separately. I think all the doubt is over. All the doubt is over. Today all doubt is over. And I think most of the doubt of previous day is also over. Understood? Correct? Yes, sir. So if any doubt of previous day is pending, okay, so you can ask me today. Are you getting benefit for this doubt session? Are you enjoying this live doubt session? Because every day now I am going to come. When I am not coming now, so I'll inform you. I will inform you. If I am not giving the link, means if suppose you are not getting any live link of that particular day for in YouTube channel, it means I am not coming live because I might be busy with some other work. But normally I will come. Okay. Are you getting benefit with this live doubt session? Are you enjoying it? Whether it is helpful or not? Bolo. I think it is helpful. Okay. Any other question? I'll wait for what? Another. Yes, sir. Thank you very much. So, of course, I think all the doubt of today's session is over. I think other students are not asking any doubt. So, can I take a leave? So, very good night to everyone. You continue your night with study. You all continue with study. I will go for sleep. Okay? Correct? You continue because you need to become CA. Huh? I am already chartered accountant. Okay? So I'll sleep because I will need to wake up in the morning at 6 because my class is at 6:30. So I need to wake up at 5:30. Okay. Okay. So I will go for sleep. You study. You carry on your study. And if you want to sleep, you can sleep. But you also then take a sleep of only 5 hours. Not more than that. Okay. Chalo. Thank you very much. Love you all. Bye bye.